on the overall macro picture because that definitely merits a mention at a time that we're looking at high interest rates, inflation on the rise, what is going to be next, as well as a fear of global stagflation. Joining in to discuss that and lots more is Chetan Ahya. He's Chief Asia Economist and Global Head of Economics at Morgan Stanley. Chetan, many thanks for taking time out and joining in at a fairly precarious time such as this when we are seeing inflation surprising on the upside, as your report says, and central banks clearly seem to be turning fairly hawkish. At a time like this, do you believe that we are seeing a lot of these risks to inflation and policy normalization that will be skewed to the upside, and that's going to be the trajectory that will continue going forward back home?
You mean to say in India or in the region?
Yes, in India in specific.
Yeah, that's right. I think the inflationary pressures will continue in the next few months. We think inflation will remain above 6.5% or so in the next few months and then moderate towards 5.5%. But I think what is important is that the RBI should be taking up interest rates higher, as they've indicated in their last statement, that they would like to get back to 5.15% quickly. I think the RBI needs to kind of stay on that track and take policy rates higher. We do think that the policy rates needed would be quite meaningfully higher than where we are today. So we have the terminal rate at 6.5%. We expect that the RBI will lift policy rates by 50 basis points in June meeting, and then another 50 basis points in August meeting. That's the pace which would be required to ensure that inflation expectations don't become a problem for India. So yeah, we do expect that normalization will have to happen at a rapid pace now.
What about the worries of stagflation globally? Is that emerging as a real risk now?
Well, we have seen that stagflationary impulse emerge even more loudly with the invasion of Ukraine by Russia. And I think that still is reverberating through the global markets, and we still continue to have commodity price pressures. But we wouldn't call the outcome of the state of the economy as stagflation, because we are still seeing expansion in various parts of the world, especially in the US, which would be an important economy to kind of qualify us to be in stagflation or not. And one important variable that we would look at for stagflation is that unemployment would be rising. Right now, we don't have that. Today we will get the U.S. jobs data for non-farm payrolls. It will still be a pretty robust number. So I would say it's moderate growth and high inflation rather than describing the state of the economy as being in stagflation.
So what does that do when it comes to the growth projections back home? Will you be revising your growth projections going forward? And what do you believe, Chetan, could potentially change the tide when it comes to the overall sentiment of growth picking up, given that we're in a fairly precarious environment at the time being?
Well, I think, India is not, is part of this world. If the world is seeing this tension because of higher commodity prices and terms of trade shock, India is also seeing that pressure. And so we have been cutting our growth rates for India. And right now we have, for 2022 calendar year, our GDP growth is at 7.5%, which is 12-month ending December 22. And next year we are at 7.1%. We do see downside risk to that now because of this persistent pressure on commodity prices, especially oil. And at the same time, we are now seeing China slow down, and that will have an impact on global trade and global growth. So there are some downside risks to these numbers, but India will still be in a much better shape compared to the rest of the world. Because India is also now finally seeing the benefit of full reopening with Omicron wave behind us. And the cyclical momentum in the economy is relatively healthy, that it can withstand this downtrend or downward pressure from higher commodity prices and still deliver healthy growth numbers.
Chetan, the other thing that I want to talk about is this rising inflationary scenario, and this pertains to India as well as the world at large. While central bank policies are acting, Fed, of course, has been ahead of the curve than RBI. But I wanted to understand whether or not in this high inflationary, extremely volatile scenario, will they really be effective, considering inflation largely is supply-led?
So I think it's both the Fed and the RBI are definitely not trying to address the supply side inflation by tightening monetary policy. The way I would think about the Fed and even India is that economy has recovered to very strong levels. If you think of the US, it's back to pre-COVID path in terms of GDP, and labor market is extremely tight. So they need to manage the demand side and keep that under check to ensure that you don't lose control on inflation expectations. So far, they have been still well behaved, but they therefore need to be on time and lifting interest rates to ensure that you don't have second round effects of this rising commodity prices feeding into inflation expectations, because demand is also pretty strong. I think the same is the case with India. If you think of it, my previous boss, Stephen Roach, who is ex-Morgan Stanley chief economist, had a very important lesson that when you are in crisis, you leave monetary policy in crisis level of interest rates. But when the economy is going through some kind of recovery, even if it is not that strong, you need to have your monetary policy or interest rates move in line with that type of recovery. And so if you think of India, while we are not seeing, output gap closing, recovery has been reasonable with this Omicron wave being behind us. You saw the PMI numbers yesterday for both manufacturing and services. The recovery is pretty robust. And so to have crisis level of interest rates while your economy is in a robust shape and inflation is picking up would not be fair. And so I think that's what RBI is trying to do, is to normalize monetary policy in the context of the fact that the recovery has been relatively strong. And you are running the risk of losing control on inflation and inflation expectations if you leave interest rates in such high levels of negative real interest rates.
Right. Chetan, so we've seen a 40 bips out of turn move from the RBI already. What's in store for us? Are we looking at just the beginning of an interest rate raise trajectory?
I think I would say that we are at the beginning of a rising interest rate regime. Our view is that inflation will moderate and it will go below 6%. To be around 5.5. But even if you are at 5.5, if you think that the normal real rates in the system should be at least about 100 basis points, you need to get back to 6.5% nominal repo rate. And so that's the reason why we are forecasting terminal policy rate at 6.5%. And mind you, there are upside risks to that inflation forecast of 5.5%. So in our mind, 6.5% is sort of the base case. There is a risk that RBI may have to do more if it wants to have the real interest rates in the range of 100 basis point positive.
Chetan, so let's understand the cycles. You understand it much more than anyone else. Typically, a cycle will last for many years. It starts with monetary support, then leveraging and corporate capex starts, and then you will actually see a reversal. So first there was a crisis, we came out of the crisis, and just when the leveraging and the capex cycle started, a reversal has started. Isn't the cycle too short-lived? I mean, ideally the cycle should have lasted a little longer before the reversal would have happened.
So that's a very, very interesting question. So first of all, I think when you're thinking about business cycles, the US is the one which determines the global business cycle duration and the time period for which it will last. So when you think about the US, we had written a report about a year and a half back on this topic. that we are going through a regime shift with inflation being structurally higher. And when you have inflation returning, business cycles will be hotter and shorter. So if you think of it in this cycle, what we have seen in the US is that policy response had been so strong. We have reached low levels of unemployment, which would be kind of closer to a late cycle period in the shortest possible time. And so that's the reason why you should think about business cycles being now shorter than what they used to be before. So last 4 business cycles, the average duration has been about 8 years. Sorry, about 9 years. And now for this cycle, we at that point of time identified that it would be about 4 to 5 years. And that's because of this dynamic that I mentioned to you, that now there is a regime shift. Fiscal policy is going to be more active, and fiscal policy helps us to get back to the low levels of unemployment much faster. And therefore, you have to think about risk of business cycles ending in earlier than before. One other point that you should keep in mind in the context of business cycles is that, in that period, in that last 10 years, if you think of it before COVID, we had structurally low inflation. So any sign of a threat to the business cycle and downside risk to growth, Fed could come to rescue. But now when you have inflation, Fed cannot come to the rescue and try to protect growth outlook, because it has to also focus on inflation. And we are seeing that live, right? We saw this geopolitical tensions putting in downside risks to growth, but Fed cannot be taking that on board and just focus on growth risks. It has to look at inflation risks as well. And so, yeah, I think that's the challenge of this new regime that we have entered into.
In a commodity boom and a bust, the wealth effect will shift from a consumer to a producer. So what happens to the boom part of the world, whether it is crude producers or metal producers? Do you see significant growth coming in those pockets, and they may compensate for global growth?
Well, I think that is a positive story which can be working in an overall basis as a net accretion to the global economy, only to the extent to which you don't have a big inflation challenge. Now that the inflation has become such a big issue, you are going to see a challenge for the global business cycle, because that's going to be net negative, with central banks having to contain growth and slow growth to ensure that inflation doesn't become a bigger problem than what it is already. So I would say that, you can look at the parts of the world which are benefiting on account of high commodity prices. But when you think about the world as a whole, this is now gotten into a stage where it's got to be net negative for growth outlook.
So if I say that it is time to say hello to stagflation, nobody likes this word. As a student of economics, stagflation is the worst thing that anybody can ask for. But is stagflation there now? And is it here to stay?
No, Aisha was asking that earlier. No, I don't think that we can still call it as a stagflation. I would describe this as moderate growth and even higher inflation, but not stagflation. Stagflation would mean that we don't have the stagnation part of the definition being met as yet. If you think of it, from India perspective, that would mean growth rates of, kind of below 5%. Would be kind of, in Indian context, that would be some kind of, stagnation kind of growth number. We're not forecasting that. And from the world perspective, you would say recession is 2.5%. Global growth below 2.5% would be a recessionary threshold. And we're not forecasting that either. So I think, this would not be fitting in the definition of stagflation. I just think it is still higher inflation regime rather than stagflation.
Just to wrap it up, the change in terms of the preference of PLI schemes, China plus one, less and less dependence on crude as a preferred mode of transport. These are large changes, and these are perhaps decadal changes which will have an impact on the way how world would be producing, consuming and manufacturing. What are thoughts on these big trends, whether it is related with PLI schemes in India or China plus one policy?
So we are very constructive on this development as far as India is concerned. I think there are two forces at play. There is a shift taking place in the world, as you described, with the emergence of multipolar world. On top of it, we've had the added challenge of the supply side disruption that are going through in China right now because of COVID restrictions. That's triggering a shift in multinationals' thinking and their effort to diversify supply chain. And India is definitely coming up as one alternative. But I think the more important shift and change is that the government is making a concerted effort to focus on manufacturing and manufacturing exports. We've always seen that challenge in India, that the focus was more on redistribution rather than trying to push investment. But now, over the last few years, I would call it like last 3 years, there's a consistent effort from the government side to push investment and encourage corporate sector to make profits and create jobs. And I think that big shift that is taking place in India is a more important driver for India's story. So we are expecting manufacturing to see a bigger share in GDP in India. And at the same time, we are expecting India to gain market share in global goods exports. So it's not just dependent, therefore, on the global beta of trade growth improving, but it just gets the alpha of increasing market share in global goods exports. And we've already got the evidence in the last 6 months. If you see, India's market share in global goods exports is rising. But we think that this will be a multi-year trend emerging from here.
Chetan, many thanks for taking time out and joining in, giving us your outlook on what the overall macro picture looks like, the stagflation worries, rising inflation, as well as central bank action.